The company performed very solidly in 2011 against a backdrop of very difficult market conditions. We were able to grow rental income by in excess of 14%, principally through acquisitions at Kingston and Leicester, which added about 6.5 million of annual rent, but also within the portfolio where there was a further 2.1 million of annual rent achieved through lettings. Principal amongst those was the lettings in our shopping centre portfolio involving BHS and River Island, but also in our industrial portfolio at Dolphin Industrial Park in Sunbury, and our central London office portfolio at Arlington Street, St James. That growth in rental income was a key component of the uplift in capital value, which represented about 1% of the portfolio. The key performers within the portfolio being the central London office holdings, retail warehouse and industrial holdings. Overall, the portfolio returned a 7.6% total return, broadly in line with the IPD benchmark. However, was supported by a very strong income performance, which is in line with the company's principal objective of providing an attractive level of dividend to shareholders. There's been a lot of good work undertaken within the portfolio during 2011. However, I believe the key highlight was securing a 150 million bank facility from Barclays Bank. This gave the company the opportunity to acquire two prime income producing assets which were able to support improved dividend cover. The first of those was the St George's Retail Park in Leicester, an open A1 retail park with tenants which includes Mothercare, Toys R Us, PC World and Wickes. And the next acquisition was the company's first leisure acquisition in the Rotunda at Kingston upon Thames, which also offered a very strong income profile through leases to Odeon and David Lloyd, amongst a number of other restaurant operators. The Barclays facility has also helped support a number of asset management initiatives within the portfolio, all of which have improved rental levels. Notable amongst those has been key lease re-gears at Q Retail Park in Richmond, as well as a lease re-gear at West Street, Marlow, involving Sainsbury's. All of those have helped improve dividend cover across the portfolio. Leicester has been a major contributor to the very strong performance of the retail warehousing holdings within the portfolio, and since acquisition we have secured a planning consent and a pre-let with Tesco for a new 73,500 square foot store, which has the potential to improve rental levels within the park and drive values once the pre-let conditions have been achieved. As for Kingston, we hope to be able to complete a letting of one of the restaurant units there, which will be a significant step towards one of the company's major objectives for that asset, which is the establishment of a new rental trone, which will improve rental levels and support capital growth for that particular asset. The company fell victim to a number of retail administrations throughout 2011, with particular tenants in question being TJ Hughes, Jane Norman and Hawkins Bazaar. Overall, that's impacted rental income by about £780,000 per annum, representing about 1.1% of the overall portfolio. In most cases, these units have been re-let to alternative occupiers, either on short-term lettings or overall improved terms. We have a regular dialogue with our property managers and our key advisors to have a better understanding of the overall dynamics of the retail market, and we meet as many of our tenants as possible to gain a better appreciation of the challenges that they face in the market and how best their objectives and the company's objectives can be met. In addition to that, as Ignis Asset Management manages approximately £70 billion of assets across all asset classes, we regularly meet with our colleagues in the equities and fixed income teams and exchange views on a number of our retailers. The company's bottom-up approach to acquisitions and stock picking involves a very robust due diligence process, and inherent within that is gaining a better understanding of the nature of each tenant's business, but also a full appreciation of the role the particular asset in question meets the tenant's requirements. Following a period of consultation with Shrewsbury Council and a public consultation last summer, the company lodged a planning application in January 2012 for the redevelopment of the Riverside Mall shopping centre, which involved the redevelopment of that site to create a further 160,000 square feet to accommodate a full-line department store of 95,000 square feet, an additional 50 retail units, 10 restaurants, together with some offices and car parking. Securing planning and a pre-let will be added value and will give the company the opportunity to explore a number of options to progress the scheme to create best shareholder value. In the meantime, we continue to focus on maintaining and enhancing income through a number of short-term and longer-term lettings. Most forecasters foresee a period of very limited growth for 2012 and a lacklustre performance for the following years in the UK and other countries as they continue to deal with the ongoing balance sheet recession. With limited demand in the economy and the ongoing process of deleveraging, there is a further expectation of quantitative easing throughout 2012. Against this background, interest rates are expected to maintain their current levels until 2013-2014. And although inflation is expected to continue to fall throughout 2012, there is a further expectation that unemployment will remain at its current levels, if not higher, until at least 2014. The market will continue to be polarised, with prime assets and wealthier locations retaining their competitive advantage. However, there is an expectation for the first half of the year at least that the secondary assets and those over-rented assets will decline in capital value terms. Expectations are for the market to be hit by weakness in the retail sector, with rental growth only really evident in central London retail and the wealthier locations. Elsewhere, the limited growth in real income and rising unemployment will continue to impact on rental values and increase vacancies, further reducing the prospect of capital values. The London West End office market continues to show strong rental growth, driven mainly by tight supply. And although there have been signs of rents slowing in the city market owing to the ongoing financial crisis, they are still expected to show an outperformance against the rest of the country, where rents are expected to fall in light of the government's ongoing austerity measures. Industrial assets in London and in certain southeast markets are expected to show strong rental growth for the next 3 years, although possibly just in line with inflation. Beyond that, the expectations are for industrial rents to fall as the ongoing concerns of the economy affect occupier demand. Ignis expects a total return for 2012 of 5%, slightly down on the previous year and reflecting a modest fall in capital values, particularly in the retail sector. With a very firm focus on income, the expectation is for a real return from property over the next 3 years, with Ignis forecasting a 6.9% total return.